Hey traders and investors, it's Christopher Mullen from thetechnicaltraders.com. I want to show you a strategy to get around these markets. Eventually, we are going to have a major market correction, and the big questions really come down to, do you have a plan in place? Do you know what to do once the market does start to roll over? Do you have a way to identify this? And so that not only can you avoid the next major market correction, whether it's just a COVID type of financial reset, quick and swift but painful, or a multi-year, something that takes 5, 10, 12 years, like the tech bubble that burst last time or the 2008 financial crisis. So if you don't have those, I'm going to show you a way to go about doing this so that we can take advantage of the markets. And the strategy uses ETFs, and I'm going to show you these. Once you understand how these markets move and how we can navigate them, I'm going to show you how you can double your account value with very little risk. You do not need to swing for the fences, and you'll be able to more or less retire 10 to 20 years earlier easily, or generate a whole lot more money in retirement if you are already retired. So that's the strategy I want to show you and teach here. It's called asset revesting. And before I kind of jump into things, I just want to remind everybody that this is for educational purposes only. This is meant to provide you information to learn about the risks and reward of trading, but you need to consult with your own financial advisor or broker to make sure any trade is suitable for your personal circumstances. So, long story short, we have the SP 500 here. This is the monthly chart, and eventually one of these is going to happen. We see multiple corrections of 50% or even a lot bigger. The NASDAQ can be 70, 80% correction. We've seen much larger corrections back in history. But overall, one of these is going to happen. And there's two types of things that happen that delay and kill our returns. They are called drawdowns. And most people don't understand that there are two types of drawdowns. The first one is the one that, if you know of them, it is most likely just the value. We lose value. The drawdown is the value from the highest value down to the lowest. So your account has drawn down in value 50 or 57% during these last bear markets, which is very painful. Now, the thing is, we can always make our money back, and we can do so, as I'm going to show you here very quickly. But that's not the painful part. The painful part is the time drawdown. This is 13 years wasted of no returns, of high stress. All kinds of bad things happen during bear markets, health-wise, marriage-wise. We had in 2008, 2009, there was over 7,100 suicides directly linked to falling stock prices. So this is serious. This is why I'm sharing this strategy and want to bring a bunch of myths and things that you may not actually realize you're doing with your current positions or your portfolio or that your advisor is doing, because these are going to catch you off guard. So what this is, what I can't help you is if you are somebody who's frequently trading, you think you always need to be in trades, and you think you need to hold a whole bunch of different assets, you love certain assets or commodities or sectors, I can't help you, because investing smartly means holding only things going up in value, and we don't get connected to them. We move to a different asset, and we can go back to the things that we love when they're in favor. So I can help you if you are worried the markets are dropping and you value high growth and capital protection. And of course, if you're managing your own money, or you don't think your advisor can protect your own money, then you're going to definitely want to see what I'm going to show you here. And you'll be able to retire a whole lot sooner, or with a lot more money, if you follow a strategy like this. And you'll realize it's almost like earning interest. The risk is very little to the downside, yet you continue to grow by leaps and bounds, more or less year after year. So the reality is the not so fun part. And if you're an active trader, you're not going to like this presentation, because what I'm going to show here is exactly why active trading is very dangerous. And if you're a passive buy and hold investor with an advisor and you've rode out the roller coasters, then you actually might really like this, because you're never going to retire early with the buy and hold investor. You're guaranteed to go through the roller coaster ride, suffer huge amounts of emotions and stress, And of course, you need 40 plus years of long-term investing to recover from these multi-year drawdowns and losses and wasted decades, which I believe we're coming into a lost decade of returns for most investors, which is not what you want if you're entering into retirement. And all we have to do is a few trades a year to navigate these markets. We don't have to be active and trade a lot, which most active traders have been proven through studies that 97% of active traders over a 300-day period lose money, even during a bull market. So it just shows how hard active trading is and how painful and slow and not efficient the buy and hold investor strategy is. So what I want to teach you are a few different things. So the stock market, now this is the weekly chart of the SP 500. We got the COVID crash. We've got the rally up here. I want to walk you through how I view the markets, and I think it's in a way that you'll really connect with. So I'm a surfer. I live on the water, and if you're near an ocean, then obviously you know there are rising and falling tides. So the stock market works the same. There's generally a bullish or rising tide environment, or there's a falling tide or a falling stock market environment. And it's important to understand where these turning points are, when the momentum has shifted from bullish to bearish. Now, when a tide goes up, it lifts all boats. When the tide goes down, they all go down with it. And it's the same for stocks. During a rising tide, you can pretty much throw a dart. Some stocks and sectors will do better than others, but in general, they all go up. And when the market or the tide is going down, you don't want to own any stocks or sectors or any of that stuff because they're all linked together and they're naturally all going to go down. So knowing when to play the upside, knowing when to take advantage of different assets or falling pricing during a falling tide is very, very critical for success. Now, if we take a look at things on a bit of a shorter term time frame, this is November of 2023 of last year, and we can see here this is the SPY daily chart. What we want to look for are waves in the market. So think of a surfer floating out past the break on a beach. What are they sitting there kind of relaxing, waiting for? They're waiting for one of those, a wave to roll in. A bunch of waves, they pick the wave that fits their position best, and then they ride that wave. And that's what we do in the stock market. We can identify money flows, sentiment shifts, all of these things, cycles, identify when the market has changed trend, and we ride these waves. And the nice thing about riding a strong wave is that we also know when the wave is starting to weaken, and we know when to start trimming profits. Moving our stops up is important, and then we can get off that wave, carve off before it crashes and takes us down with it. And then we can rinse and repeat and catch these waves. Now we're still long. We're long the equities market right now. This is October 14th when I'm recording this. And the markets are still showing that they have quite a bit of upside, another 4 to 8% to the upside from where we are, which is pretty exciting. So the markets are ripping up. Now, it's the same for when the stock market is falling. This is 2022, and the markets fall a lot different, move a lot differently in a falling market. But you can see there, the green bar is very little upside potential. And all the potential is actually on the waves to the downside. So during these times, you can trade inverse ETFs that go up in value as the stock market falls, or you can go to a different ETF that might have lower volatility and go up. During this time, the US dollar ETF, UUP, rallied 18% while the stock market fell like 25%. And the UUP ETF that rallied, its biggest pullback through the year was less than 4%. Very, very slow, consistent, low volatility. You don't break a sweat at night worrying where it's going to be the next day just because it doesn't move much, but you can catch very nice trends to the upside. So that's how we want to play the market. The stock market has 5 to 12 waves each year. It'll vary depending on the market condition, but that's all we're looking to do is we're looking to rotate our money into a wave during the right tide direction into whichever asset is favorable at that time. Could be stocks, could be bonds. I'll show you these, the dollar, I'll show you these plays here in a minute. And if you rotate, so you're only holding the asset where the money is flowing to, you end up with a very strong, a very consistent equity curve to the upside. Now, here we've got the SP 500, we're dramatically outperforming. The 60-40 buy and hold portfolio is painful, just hasn't been performing very well at all. But we're able to generate consistent returns during bear markets in 2008. During the COVID crash, we were able to ride that higher, as I'll show you here in a minute. And then during the 2022 bear market, we continued to push up and we keep hitting new all-time highs with our accounts almost every month or every quarter, depending on how the market is moving. And we just keep doing that. And I call this strategy CGS. It stands for the consistent growth strategy. And that's what I'm going to show you here is how to only hold things going up and remove all that downside risk and really enjoy the process of investing and not have to be really busy. So to generate higher returns, we need to understand a set of things. We need to understand that there's market cycles at play. There's 4 stages of the market, and the market participant emotions. And if we know all of these, we can navigate the markets and identify where we are within these. And from there, we're going to manage our portfolio with an asset hierarchy, which I'll walk you through, of telling you which asset to own. And then, of course, we want to avoid some of the retirement silent killers, which I will explain as well. And some of these, they're silent killers because most people don't know about them until it's too late. By the time you know about them, the damage is done, your retirement is over, or you're out of money in retirement and you can't recover from them. So I want to make sure I cover, especially one of them, really important here at the end. So here are stock market cycles. So we have 2 cycles here. The blue one is the stock market cycle, as you can see down here. The other one is the economic cycle. Now, the stock market will bottom before the economy and it will top out before the economy. Simple. Investors are savvy. They see businesses after they've gone through a huge sell-off, they start to see sales pick up and their projections start to get positive. So investors buy into shares and drive share prices up when they see the forecasts from companies starting to improve. So they buy the shares, they drive it up, and now the stock market will top out before the economy because they see sales starting to slow a little bit. The projected next quarter earnings might be lower or flatlining, so investors start to move out and stocks start to go down, and then eventually the economy, which is usually about at least 6 months delayed, will finally say, oh, we're finally in a recession, but the stock market will already be well underway and starting into a bear market. And a lot of times this topping phase, this is where people say, oh, the economy is really strong. Why is the stock market going down? But it's because savvy investors who know what they're doing can see forward and they can put the pieces, they can align the stars together and be like, okay, this draws a very clear picture of what's going on, the direction we're headed for stock pricing, for economy, and all of that stuff. Now, what's interesting here is near a major market top, we've got precious metals like gold, we've got energy stocks, and industrial capital goods. So if we were to take a look at these, gold is one of my favorite charts. Here we have gold trading near all-time highs. Now this is a little bit older, but we're trading up at about 2,700 right now, which is where we're expecting. We've been expecting 2,700 to 2,750 for gold for really the past couple of years. The 15-year chart pattern using Fibonacci extension showed this 2,000 mark as one target, and if this target gets hit and it pauses, then we go up to the 2,700 target, which is where we're at now. Now, what's interesting here is last time we got into a major market cycle like this for precious metals, gold started a super cycle and then it went dormant for a couple of years. And while it went dormant is when stocks skyrocketed and shot higher. All the money was going into the stock market. And then suddenly out of the blue, after a massive multi-year rally in stocks, we saw gold break out and start to run up. And this is the early warning sign. This is what we're seeing right now. Now, we had gold break into a new super cycle in 2019. It has gone dormant while the stock market has surged over the last several years. And now gold has been taking off and running higher. And gold is like, think of the world or the planet as a giant beehive. It's a hive mentality. Gold tells us what everybody around the world is doing, where they're putting their money. And people think stocks are overvalued. They're scared they're going to fall. They're worried about, other investments like real estate. They're worried about currencies. We've got war going on. And so people move to gold, a physical asset outside of that financial system. And so when people start to get nervous and the stock market keeps going up at the same time, but gold is rallying, that is telling us we are very close to some type of market correction, black swan event, whatever it is you want to call it. And we saw this actually creeping up here going into COVID as well. We saw gold breaking out and running, knowing that something was brewing and getting pretty ugly. Now, what happens during a bear market is we see almost everything goes down. When we get into a stage 4 decline, which I'll show you in a minute, even the safe haven plays are not safe. We saw gold pull back 34%, silver pulled back like 65%. I think gold will have a big pullback again. It'll be one last great opportunity before we go into another multi-year rally. Now, the other sector here are energy stocks. Energy stocks right now are trading up near all-time highs. Last time they got up here, the last couple of times we went into the 2008 financial crisis, went into another kind of weak economic environment over here, and we're back up into this nosebleed section. Typically, energy stocks are holding up really high. When there's uncertainty, people think that when there's war going on, they're expecting oil prices to skyrocket. They think businesses are strong and there's going to be lots of demand for oil. And so this is another red flag. It's at the upper end of its range. It could cycle lower at any point here. And then last but not least, we've got industrial capital goods. Now, this is like COVID has, I think, blindsided a lot of people. So a lot of factory workers and managers who say, hey, we're at max capacity. We need to upgrade our business. So everybody has been buying new equipment for their warehousing and assembly lines and all of that stuff. And there's a huge delay. And we have big interest rates on this stuff now. And so the capital goods, industrial goods companies have done very well because everybody just had the COVID surge. They all think they have super strong businesses and they don't see it letting up. So they've all upgraded and we got some record earnings for a lot of companies here. And this is usually a warning sign that everybody's upgrading. And when everybody's upgrading and feeling really good, that's usually when the music stops and then we go into a recession. And a lot of these companies will be like, why did we spend $5 million on a new assembly line? Because 6 months from now, we'll probably have, or a year from now, we could have half the demand and they could run perfectly fine on their old line that was paid off already. And this is what leads into bankruptcies and layoffs and all that stuff. It's a big vicious cycle. So as the stock market starts to put in a major top, usually there's going to be another asset that could rise from the ashes, which is the bond market. Now we're finally starting to see the bond market come to life. It's trying to carve out a bottom here. Anybody who held bonds after COVID has had their massive losses in their portfolio. They obviously don't have their money managed properly because a rising interest rate environment means bonds are going down. There's no reason to be holding bonds during this. You should have been out, if anything, betting against them to profit from falling pricing. But now bonds are trying to work themselves up with rates having stalled and starting to come back down. So if we take a look at the next cycle here, let's look at the economic cycle. Now this one's pretty interesting. So the economic data is starting to show some pretty cool stuff. So this is the unemployment rate has crossed the 24-month moving average. Every time it has done this, we've got a red line on here. This is some type of financial reset, some type of recession takes place. So we have had this cross and now we're just waiting for the momentum to stall out and for the recession and bear market to take hold. Now, obviously, if unemployment starts to go up, people start to run out of money. And one of the things we found here is depleted excess savings since COVID. This is a cumulative pandemic excess savings, and we are back down below where people's savings levels were before COVID, before money was kind of helicoptered out to save everything and everybody. And now people have burnt through that. And this is where we're starting to experience delinquencies in credit cards. We've got one of the highest level of maxed out credit cards that people just aren't paying. So this is a huge, huge red flag. We're also seeing defaults across mortgages, both residential and commercial, in a pretty big way. The banks are going to be left holding the bag of no money, but a lot of assets worth a lot less than what are on their books. So let's take a look at market structure. So this is where the kind of technicals start to come in. It's important to understand that there's 4 stages to the markets. Stage 1 is a basing stage or a sideways move. I have it shaded red because it's very difficult to make money. Stage 2 bull market is what everybody loves. Stage 3s are very difficult to trade as well. We've been in one since March of 2021. Even though the major indexes have been pushing higher, most stock and sectors have this chart pattern. They've already broken down. They haven't recovered. It's just the Magnificent Seven have done what I call camouflage. They've made the markets look really strong, even though the whole market has really been dragged up by a handful of stocks, making people think things are good while they're not. And then we go into a stage 4, which is where most people lose their shirts. The market falls 4 to 7 times faster than it rises. This is where we can make a lot of money in a very short window of time, doing a couple simple strategies. Actually, just one simple strategy that we can do multiple times throughout this downward cycle. And so this is where we're going to focus on once the market does change direction, and it just hasn't quite done that yet. Now, if we look at market participants and sentiment side of things, if you become a technical trader, something that I do, or follow the charts, follow the money flow, follow the trends, you get to experience this really exciting upward phase twice during a cycle. So, for example, here, price starts to rally up. People get optimistic about, finally, I think we got a new bull market coming. It rallies even higher. Finally, there's belief. We're in a bull market. Then we're in a thrill phase, people making lots of money. And then you get this blow off top where everybody feels like they're a superhero and they're going to be rich. And that's usually where the top comes in place. But what's going to happen here is the market's eventually going to start to break down. And if we actually look at the equal weighted SP 500 and the Russell 2000 and the microcap sector mixed together, it has actually formed this chart pattern. And eventually, once it starts to break down, investors who are complacent right now, they just think the markets are in a strong uptrend or that they're going to hold their value for a long time before going even higher. They're going to start to get anxiety as it breaks down. And eventually, it's going to start to fall enough where they realize, oh no, I can't believe we're starting another bear market. We just went through one a couple of years ago and I can't afford to lose anymore. And then eventually they lose so much that they're like, at this rate, I'm going to be broke and not be able to stay retired or retire if I hold on any longer. And they panic out at the bottom and then they get angry and depressed and all kinds of bad stuff happens. Now, if you are a technical trader where we follow these cycles and trends and we know how the markets are moving and why, when people get anxiety, we actually have optimism. And that's where we're starting to get close to. We're starting to get excited. We're optimistic about a stage 4 coming because it's going to be a reevaluation event. We'll have affordable stocks. We'll have real estate and business opportunities. All kinds of stuff will be available. And so we're getting excited. As people have denial, we'll be in full-on belief. We're like, yeah, we saw this coming. We're taking advantage of falling prices. As people are panicking, we're like, this is taking candy from a baby. This is icing on the cake. And then we know eventually as it gets down to this anger depression state, which is really just the euphoric phase for us, we know it's coming to an end and we're just milking it for everything we can, knowing that it's volatile and that it's about to come to an end. So that's kind of the cycle. You either live this cycle or you live a good cycle in both directions and are able to rack up your account values very quickly. Because keep in mind, a bear market, 9 to 16 months, the average bear market, you can make, sometimes 7 years worth of returns in a year. So there's quite a bit of potential and growth here. And then, of course, when you have record wealth, you can reinvest it at the start of a new bull market where dividends are massive and you can ride the whole cycle up again. So I do talk on this stuff. I have 2 books, Technical Trading Mastery, 7 Steps to Win with Logic. I cover the stages and all the stuff in detail. My newest book, Asset Revesting, on how to always hold assets rising in value and rotate through them. So you can follow these books, check those out if you want to get more detail. But let's take a look at how to buy the correct asset. And this brings us back to the asset hierarchy. And so I have these ETFs in our hierarchy. And the ones at the top are more volatile. And as we move down, the volatility decreases. And so we naturally always want to hold the stock market because it has the most volatility. And if it is trending up, we want to hold it for maximum returns. If not, we want to look to bonds, which they really haven't been in favor for a few years. And if they're not in favor, we'll look at the dollar index or the inverse dollar ETF, or we'll go to a cash type of position where we earn daily interest and monthly dividends while we safely sit on the sidelines, floating out there past the break, waiting for a wave in one of these asset classes to take advantage of. And if we do that, here's how we navigated COVID during that time. So we are long the stock market, SPY at the top. The trend changed. We had the trend signal change. At that time, our strategy said TLT, move to bonds. It is in a strong uptrend. Money is flowing there. We caught a 19% move in 9 days with COVID, with TLT. And it gapped up above our 15% target, up at 19%, hitting our targets and closing out our position. And then we went to cash because nothing else fit. And we just earned a cash dividend and slight growth while everybody was panicking about COVID. And then once the dust settled and the strategy kicked back in and said, hey, the stock market trend is back up, get back in. We bought the stock market back at a 12% discount and then had an upside of 18.5% rally from that point before the next market pause and correction. So that's how we walk through the markets. We're in stocks, and then we move into bonds, and then we move to cash, and then we go back into stocks, and then we rode back into a cash position over here. So we just rotate through these. Very, very simple, very slow. We see trades coming a few days in advance, so we're warmed up. We generally know when a trend is about to end a couple days before it does, so it's no shocker. And that's how we go about these markets. Now let's quickly touch on one of the retirement silent killers, and this is where things really come together for the power of what I'm showing you here because it allows you to completely avoid this. Now, if we take a look at this is called sequence of returns risk. And this happens when you're in the retirement phase where you start withdrawing money from your investments to subsidize your retirement. And so here are two traders, Mike and John. One's aggressive. One is consistent or conservative, whatever you want to call it. And here we go. We have they both withdraw $50,000 a year to help subsidize their retirement. And Mike does fairly well. He averages about 8% return a year. He's got some bad years, some really good years, 35, 43%, 16%. And he averages that. And after 10 years of withdrawing money and all of that, he ends up with $818K still, which isn't too bad after 10 years of retirement. Now we go over to a consistent trader or a conservative trader. He doesn't have big losses, but he also doesn't have any big gains, just mellow yellow, just super chill, vanilla. And he only makes 6% a year, or 6% on average per year. But he ends up with $1,189,000. Now, it might not sound like a big difference, but that's actually $370,000 more. It's 45% more money than Mike after 10 years for doing something that is probably way less stressful, probably a whole lot less trading, and it's definitely not stressing you out and is giving you a better lifestyle. And so why this happens, even though this guy makes more per year, is he has volatile years where you withdraw $50,000 from your account and then you lose 14%. And then the next year you withdraw $50,000. So now your account's even lower again. And then you make 7%. Well, that 7% isn't on your $1,000,000. It's on your much lower level. You already lost 14% and you've already withdrawn 100K. And so you only make it on a smaller amount. So every time you withdraw and every time you have a loss, it just sets you back huge in terms of your returns don't come back and make as much as you need. Whereas over here, if you take a 5% loss, it really actually doesn't make much of a difference in terms of your next gain that you get because it's not a huge hit on your account. And so when you have negative years, you do a lot of damage and you start burning through your money way quicker than you really expect. And this is why most people, 81% of people are expected to run out of money in retirement in the United States. And that is a pretty crappy feeling. We work our entire lives. Last thing you want to do is have a really crappy end of your life. when you've worked so hard and run out of it because of something like this. So here is actually the buy and hold over the past 10 years versus the strategy that I'm showing you how we rotate into only assets that are going up in value or holding their value like a cash position and with small interest. So here's the 60-40, and here are the actual returns on the 60-40 per year. And after 10 years, you've averaged about 5.78%, and you still have about your $1 million you started with, which is not bad. For a no-brainer, going with your advisor and set it and forget it. But if you were to use an asset revesting strategy that I'm showing here, the CGS strategy, not only do we benefit from holding assets constantly going up in value, so we get some very big returns, but we also don't have any big losses. And that is where we end up with a very big average annual return. And you can see the value for doing something that is a little bit of effort, but manages all your risk. You end up with 3 times the amount of money. And imagine making 3 times more money every year if you're retired. That is a lot more money, interest, growth that you can just burning cash. You just spend it and have a good time. That's pretty amazing. So long story short, if we were to take a look at consistency and compounding, here we have an aggressive trader. Obviously this is pretty good returns. Like, which one would you rather have? 21, 20, 11, 9 to 17, 10, or just, a low average return? Well, the reality is, most people want to go for big returns. Like, this is pretty tough to beat. But if you go back, what this person has to do to make money is very risky, and at any point they could do a lot more damage to their account. If we take a look at the same thing, both people invest $100,000 doing both of these strategies, believe it or not, 8% being consistent, low risk, and just holding assets going up actually makes the exact same amount of money as this person who is working their butt off and taking lots of risk and constantly stressing and watching computer screens. You both make the same amount of money. And this is where the power of compounding and being consistent is. And that's exactly what the strategy that I'm showing you here. It's all about consistent growth. If you consistently grow and over time, the compounding and everything is so powerful, and it's such a low stress way to invest because it doesn't matter what the markets do. If they go up, we ride them up. If they go down, we take advantage of falling prices because we follow price and we follow the money flows. And until they have changed direction, we don't change our position. The market has to lead and we follow, and we have a very good way to follow. And if we do that, we can make huge returns since 2008 versus the other methods like the buy and hold and the SP 500. And you can see the max drawdowns, the losses people had to go through versus what we do, less than 6% at this point. I'm sure it'll be bigger down the road, but overall we keep things very contained. It's a stomachable amount of volatility versus losing half or 4/10 of your account. So that's kind of where we're at. To me, I believe the time is now to protect your capital. This is the whole reason I've come out with the new book, Asset Revesting, trying to show people that you need to understand the stages, the cycles, the market sentiment, the money flows, all this stuff, so that you know which asset to hold. You can identify when to move out of one and which one to move into, and all of that stuff. Obviously, inflation is still high. Things are so expensive to go and eat out meals and travel and all that stuff. Interest rates are still high. The economy is slowly weakening. Housing bubble is about to burst. I did a good talk on real estate recently showing some pretty crazy stats, and it's going to shock a lot of people once we get this next drop. And again, this next bear market, we could see about a 33 to 54% market correction over the next couple of years, and it might take a long time to recover. Some analysts are expecting it to be a lost decade, which it could take a year or two to go down and could take several years to come back up to these highs. And that could be a decade. And that's a long time to not have any return. And that's how you get sequence of returns risk, is a decade of no money, of no return at all. And you're withdrawing from your account as it's getting hit with value, and you lose half your value already, plus you're withdrawing. So that's kind of where we're at. Again, if you're interested, you can go to my website, thetechnicaltraders.com. We've got a big bundle here where you can save about $3,800. Take advantage of my ETF signals, copy the trades. Every trade that I do here is what I do with my own money. So I ride the coattails of the market. You ride my coattails. We just copy each other and take advantage of these market movements. Anyways, hopefully you found that interesting. Once you understand how the markets move and how to see them, it's not about trying to pick or time a top. It's about identifying trend reversals and how strong they are and if they're worthy of a overall tide change and a trend change for us to take advantage of them on the shorter term and longer term perspective. Take care. Bye-bye.